All right, let's talk about mutual funds versus ETFs in this conversation. We will also talk about index funds. We'll talk a little bit about hedge funds. What are they? Is one better than the other? Usually, the answer to those questions in finance is better for what and in what way. And how do ETFs and mutual funds relate to index funds and hedge funds? So, first things first, when we talk about stock market investing, I've generally said it's not the best idea to be picking individual stocks. We want to look for low cost index funds. And I've given you examples of such index funds that I hold. But let's now kind of define what that is to get on the same page. So, when we are talking about an index fund, and as usual, we will work through all of the different technical issues with my drawings. Okay, index fund. An index fund is, as the name index suggests, following an index. It's a basket of stocks which tracks the performance of some index. So you can have, for example, like the S&P 500, or you could have a NASDAQ index fund. Do I know how to spell NASDAQ still? Yes, I do. NASDAQ index fund. And they typically weigh the companies based on their size. And index funds can be traded as or found in the form of a mutual fund or an ETF or ETF. So what does this mean? Is it an index fund, or is it a mutual fund, or is it an ETF? This is the simplest way to understand it. The mutual fund and the ETF can follow the same index but are traded differently. Mutual funds go back a long time, really to the 20s, and the idea that fund managers can buy and sell and try to beat the market and turn investors a profit. Now, that would be called an actively managed mutual fund. But right now, a bunch of mutual funds are passive and just track an index. Some of these mutual funds have a minimum investment. In fact, it's quite common that they have a minimum investment. It could be anywhere from, $1,000 to $10,000, depending on the particulars. The trading takes place between the investor and the fund. And as long as it's an open-ended fund, they'll issue more shares as demand requires. The price fluctuations of the fund depend on a regulated valuation process that updates at the end of the day. So typically with these, you have, we will say, one price update per day. Okay, they trade in that particular way. The other thing about mutual funds is you can't really trade them throughout the day because the purchases and the sales go through at the end of the trading day when net asset value is determined. So you don't really trade the mutual fund. Now, what about an ETF? ETF stands for Exchange Traded Fund. These are newer, launched in 1993 was the first real ETF. Now, just like with the mutual fund, you could have an actively managed or a passively managed ETF. You can have a mutual fund that tracks the S&P 500 and a mutual fund that tracks, and an ETF that tracks the S&P 500. Or you could have a mutual fund and an ETF that are both actively managed and have the same stocks or different stocks within them. One difference is that there is a much smaller barrier to entry. So no minimum investment, just the shares. So if you don't have the minimum for maybe a NASDAQ mutual fund, you could trade that as an ETF and not have to worry about that minimum. Another key difference is that they trade throughout the day. Throughout the day. So you could buy and sell the same ETF. You could buy it at 11 a.m. and sell it at 2 p.m. That's a critical difference. Not critical as if it's a good thing, but it's a critical and significant difference between the two. So between the two, is there an obvious choice as to what's better? Not really. Oftentimes you have an ETF with a mutual fund equivalent or vice versa. The other thing to consider would be fees. So as a general thing, you want to look at fees for both. You might have the same index being tracked by a mutual fund and an ETF, but one might have a higher or lower expense ratio. Depending on what's important to you. Do you want to be able to buy and sell during the day? Then you would be looking more at an ETF. Do you want, in the cases of some mutual funds, do you want the lower fee? Then maybe you go the mutual fund route. Now let's talk about another couple of mechanisms. We've talked about index funds, mutual funds, and ETFs. What about hedge funds? People often say, well, but it's a hedge fund, not a mutual fund. Important to understand what this is. Hedge funds are private investments and are typically only available to accredited investors. And hedge funds are often not traded on open markets like mutual funds and ETFs. In order to become an accredited investor, for those that require that, you need to have earned over $200,000 per year over 2 years, and have a net worth of greater than $1 million. Typically, this is what we're talking about, or be certified in finance or work for a private fund. Hedge funds, and these are generalities, tend to be more aggressive. They use more options, more short selling, more leverage. And there are also hedge funds that shoot for a more modest return, or maybe are in a particular industry or a certain style or socially responsible in some way, or whatever the case may be. But these are the main things to understand. When we talk about an index fund, we're talking about a fund that tracks an index. Mutual fund and ETF are different mechanisms for how such an index can be tracked, or they can be completely separate from an index and be actively managed.